Good evening, traders. Testing 1 2 1 2. Testing, testing. Can you hear me?
Good evening.
Yes, good evening.
Good evening. How's everybody doing?
Good evening.
Oh, good.
Yeah.
Great, great. Thanks. Great, thanks. Alrighty. Sorry for the delayed start. Let's get on with it. Questions or comments as usual? Let's start with that.
You're confused about the results and the impact. Yeah,
Tell me more.
the claims were more, and the results, the inflation was down, but the dollar went up. That's the confusion.
Can we really say that inflation went down overall? We had how many data? How many measures of inflation come out today? Let's quickly check. Not in any way insinuating that it went up, but can we really say it went down as well?
Not really.
Well, it was less than previous.
Less than previous. Was it on all measures of inflation? Let's see. Let us see. If I remember well, our year-on-year, did come down, but not as much as anticipated. But nevertheless, it did come down. And every other measure of inflation was unchanged, I think. Yeah, here we go. Can see my trading my Forex Factories website. You see that?
Yes.
Okay. So we have core month on month staying unchanged at 0.3. The prediction was a contraction to 0.2. So that was a miss. Stays unchanged. We have the headline CPI. The 2 stayed unchanged at 0.2. Then we had our headline year on year move from 2.5 to 2.4. Right? So if there's any change on the inflation, it's just on the year on year. A marginal change, right? But a change nevertheless, it definitely has come down. But remember, I did say yesterday that what is considered more important to the Fed or central banks in terms of measures of inflation? Which data bears more weight? Is it headline inflation or core? Core. Right? So core comes out unchanged. That brings about some definitely, I wouldn't say uncertainty, but I would say not much of a move or improvement from the previous month. Not much of an improvement from the previous month on inflation. And of course, core, the most important one, according to the Fed, right? So, and then we also had unemployment claims that has gone up, which is, negative for the dollar. We did initially see, if you remember, if you were looking at this data, we had volatility because we've got this almost flat data come out, and then we have, unemployment claims picking up, moving from 225 to 258, suggesting more people have claimed for unemployment checks. Right? So, did anybody see that volatility initially?
Yeah, yes. It
Right?
Yeah.
Okay. Let's look at those. That was what, half past?
Half past 2.
Yeah.
Let me just try and get to it. I don't know why this thing is sluggish, but I'm still waiting for it to change to an hourly time frame. It is. You can see that there was a push to the upside. Initially, we closed lower, and pretty much then have had a recovery. Right. So they did try to push down, but that data clearly wasn't convincing enough. So the dust has settled. It's been a couple of hours. What is it telling you? Where's the dollar going? Right? What do market participants, investors, slash asset managers, smart money, do you think they're convinced by that data?
No.
Right? Remember I said inflation data will take precedence over the weekly unemployment claims because, well, that comes out every week. Inflation doesn't. So inflation definitely would have taken center stage today. And we can see that it wasn't convincing. It wasn't convincing. It didn't go up, right? It didn't go up, sure. So that's not too concerning, but it didn't go down either. It's just flat. Year on year, yes, we do see an improvement. Year on year, we're talking about last year, this time, where were we? We have definitely seen an improvement. You follow? Right? Because we've got year on year and you have year to date. Right? So, sure, there has been a little bit of an improvement, but the core, which is the important one, remains unchanged. So that risk, well, if you look at what you call this, if you look at the US stock market, you definitely do see that we have a mixed bag, right? We have a mixed bag. Remember, a mixed bag is when we lose correlation, right? That's where things don't have that usual correlation that we're used to seeing. Because if I remember well, our Nasdaq trade is still running. Yeah, there we go. TP hit. Still through personal life.
Yeah, you're
Anyway. That trade has definitely played out well. Are we at record highs? No, I don't think we are. Or I think we did test. No, yeah, we still have some room. It's a point of interest here. This is the high for the year, right? All-time highs, 20.763, run about there, right? Now, if inflation is flat, as we've seen it for the month of, what are we in, October? So for the month of September, flat. What speculations start to build up in terms of what the Fed is going to do with interest rates, or with, let me just broadly put it this way, with their monetary policy? Right? It's flat. It's not going down. Remember, I said if we definitely had a situation where inflation definitely is down for the month, on, let me not even say for the month, all the data was down. It was even better or exceeded even market expectation, right? 2.5 to 2. The expectation was what, 2.3, we got 2.4. If it was 2.2, definitely less than the previous month, less than the expectation, and also including the other, measures of inflation. If that too had, exceeded market expectations, it would have been clear that inflation is coming down, right? And that would have been an easy sell for the dollar. So it's flat. It is flat. What is the speculation out there? Is smart money speculating on the possibility of an even just as big, rather, rate cut? Are they thinking the Fed is going to cut rates in their next meeting, and by how much? Or are they thinking, hang on, the Fed is not going to cut rates? What's your understanding here? Feel free. Will the Fed cut rates? If so, by how much? Just based on this data, or no, the Fed's not going to cut rates. What do you think smart money is thinking?
I think from what I'm gathering from Bloomberg,
Yeah.
some are saying they might cut it, maybe 25 basis points. I don't know.
5 basis points.
Others are saying that it's a mixed bag, but they are speculating that they might cut it again. But I don't know. I don't see it happening. That Fed group, they don't seem to be easily persuaded. Or they don't
Okay.
listen to the noise. They don't listen to the noise. That's my sense.
Remember, I'll take that. Remember, we've said, well, let me not say I've said, the Fed has always said that they don't depend on one set of data to make a decision.
Yeah.
So this month's data, they will always say it's not enough. It's not enough, right? To simply make a decision on that. They'll say they will include that data based on their in their analysis, but the analysis is quite broad. Their sample is much bigger. They're looking at how has it been performing over the last 2 years. So remember, inflation is not always going to come down every month, down, 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 down. No, there will be times where it rebounds, right? And there are times where it continues in its downwardly trend, right? So this time around, it didn't really necessarily rebound. It's just flat. So you're saying, well, you don't believe that the Fed may cut rates? Yeah, I'll take that. It's possible that they might say, we cut by a bit in the previous session meeting, so we would need more data. They might throw that to us and say, now we're holding on, we need more data. And you've seen that many a times, right? Some are speculating, 25 basis points is still in the cards. We're going to get that. The Fed is behind, right? The Fed is behind the curve. How would they know that the Fed is behind the curve? They would need to have some sort of information, right? They would need to have some sort of information. And that information is on their site. It's on the Federal Reserve's website. It's called projections. We will look into projections in the coming days, right? This is forward guidance. It's a monetary policy tool that the most central banks use. It's a rather new monetary policy tool. Yeah, I don't think it's more than 10 years old. And basically what forward guidance is now central banks, they've adopted a strategy of communicating a bit more earlier and clear way before making a decision, so that the market can have time to interpret that data or that communication by the Fed or any central bank. This prevents a lot of volatility in the market, right? So for forward guidance, we definitely do get it from a lot of banks. You will, if you go to any website of the central banks, they let you know what their point of view is on the economy. They tell you what their projections basically, right? Where they think inflation should be by the end of 2024, 2025, 2026, and the longer run. It's not only just inflation and interest rate, other macroeconomic indicators, your GDP, your unemployment rate, etc. So that's where some of these market participants may be informing their speculation on, right? They're looking at those projections and saying, okay, but the Fed said, based on their projections, they see interest rates landing at this particular number by the end of the year. And so they see the differential between the two, the current and where we should be, right? So they know then that there's still much more to come in terms of interest rate cuts. Are you following?
Yeah.
I'll just write it down so I make sure that everybody understands. Where's my pen? Pen. So we're currently sitting at 5%. Okay, I'll try again. 5%. And maybe the Fed has communicated or projected that we should be sitting at, say, 4%. So we know that there's still 100 basis points. There's 100 basis points difference between the two. Right? 100 basis points between the two. So we are still expecting a whole lot more cutting to happen. Okay? So, excuse me. But then we don't have to crack our skulls anyway. The CME report is there. Remember that? That can give you insight into what are the big boys thinking. The CME, we remember that? The CME Fed Watch 2. Let's see. Because this definitely would have affected it. So let us see what they think. CME Fed Watch 2. Very sluggish. Okay, while that's still opening. Okay, there you go. So far, any question? Are we understanding the inflation data much better now?
Getting there.
Yeah.
Right. So the dollar is likely to remain elevated. Right. The dollar is likely to remain elevated. Well, let's see how much more buying of the dollar is. We'll look at the dollar. 28 days. We will have the next FOMC meeting. Remember, it's 2 days. So it'll start on the 27th and end on the 20. Not on the 27th, but it will start the day before and end basically the following day, which will be the 28th day from now, right? That meeting will be on the 7th November. Not ally. Is it the 7th November? Yeah, I think so. There's been a big change actually since we last viewed this report. Is anybody spotting that change? There's been a big change actually. Let me just try and get this to scroll down. I think I need to delete a lot of the recordings on my PC. I think it's slowing it down. Too many recordings. I'm stuck again, just like yesterday now. Okay, let's see. It's unresponsive. Okay, give me a sec. Let me just try and fiddle around with a few things. Okay, sorry about that. I'm back. Let's see if there's any improvement. All right. So there definitely has been a shift in the expectation. Does anybody remember what it last looked like? Have you been paying attention to that Fed watch probability? Nope. Take that.
No.
Okay.
This is all new levels. So we still learning.
It can't be new. It can't be new. It can't be new. Nothing for sure.
I think this is the third time.
Is this the
Can
first
you
time?
hear me?
Yeah.
Yeah. Last time we took a look at this, we had some persons who were on the view that we're going to have a 50 basis cut. That means from the range of 425 to 450. But currently now, it's just saying that new views are shifted now. So some persons are of the opinion that we're not going to have any cut, which is the rate of the 475 to 500 for the current one. And then a larger number of people are now expecting just a 25 basis cut.
100%. 100% correct, sir. Right? So we've got now 16%, 16.9 to be precise, who believe that the interest rate will remain unchanged. This is the current interest rate range. And remember, there was somebody who was asking about these ranges, and I said, because they can be a little confusing at times. There's my pen. Why is it not writing? So, but anyway, 475 to 500 is the current range, and 450 to 475, that's a difference of 25 basis points. So we now have 83% who believe we'll only get a 25 basis point cut. You follow? There it is, current range 475 to 500. That's where we in. That's what we are in right now. Right? So 450 to 475, that is a 25 basis points difference. So the market is currently making some adjustments basically, because initially they were pricing in yet another 50 basis points, right? And if you remember, the dollar index was, where's my pen? Let me change the color. I think that's why. The dollar initially was down, and then it was playing just at a crucial level of support, not really violating it. Okay, fine, eventually violated it, but then we went above again. So they've priced in at 50 basis points, but that wasn't the right one. So as the macroeconomic data continues to trickle in, they realize that, actually, maybe the 50 basis point was a little too much to expect from the Fed. If anything, we will get 25 basis points this time around, right? So as the data continues to come in, we will definitely see a change in this. And remember, I said you can compare, you can see the difference, you can see the change. Simply click on compare. Current range. Why is this thing not moving? Range. This was a month ago. This was a day. But this is the day before it was sitting at 19%. Now we are sitting at, those who believe on a 25 basis point, we can see at one point it was 52%, right? And now it has gone higher. A slight drop from yesterday, right? Yesterday was 80. Now it's sitting at, is this today? Yeah, 77%. Now, those who believe in the 50 basis point, that number last month was 19. I feel like there's some data missing here. This was last week at, what, 32%. So we're missing the day. Let me just refresh this, see if that will bring about the other data that's missing here. Now we can see with pricing in only 25 basis points priced in. And so the dollar will do some correction, right? So it's doing a corrective buy. Yes, we're not saying it's going to buy, forever. This is to sound dovish, accommodative, another eventually. Let's click on. But yeah, I think the point has been made anyway. I think I have shared this link under websites. So this is something, whenever you remember to check. I like to look at it whenever we've got high impact data. I'll look before the data is released. I'll look at what the current sentiment is or probability for interest rate cuts. And then I'll go and look at it after and the following day. Nice and clear?
Yes. Yes.
Yeah, bro.
All righty. Any other question? Let's look at the dollar index and see where is it going. So we've got the dollar index, as you can see, or as you saw earlier, definitely bullish. But we also had a bullish stock market, or at least a bullish Nasdaq for the day, hitting our TP. So that is definitely a mixed bag. We definitely also did see, where's the drawings? Where's the drawings? So now that inflation, I'll give you my 2 cents worth on it anyway. It's flat. And like I said, the Fed will likely say they need more data. So yeah, sure, they might not hike interest rates, or they might just give us the 25 basis points, right? But looking at the chart, I mean, should we continue to the upside? We are bullish anyway. So as we continue to the upside, we'll continue to measure, of course, measure that risk off sentiment by paying close attention to the dollar and VIX, right? Remember, the dollar and VIX are positively both moving in tandem to the upside, but definitely a risk off. If they're both moving downward, we're definitely risk on. So I'll be paying close attention to that. So should that risk on sentiment build up, your Nasdaq, your Dow Jones will continue to the upside. Now that will tell us basically that the market expects the Fed to cut, right? A cut is definitely in the cuts. The degree of the cut, well, so far that has shifted to only just the 25 basis points. But I think that will be sufficient anyway, right, to bring about that risk on sentiment. So if you are a bull, as you know what I say, if you're entering here, you're an aggressive bull. You are coming in a little late into this party, right? So what do you expect? The usual. Let's change the color here. Okay. That won't work. Let me try it nevertheless. What's going on with this pen? Okay, let's see. All right, yeah, that's right. If you're a bull, you want to see that happen. Violation, roll, reversal, that's where you need to be in. What we're targeting is the all-time highs, ATH, all-time highs. Beyond that, yeah, go ahead.
Can I check something? When you look at the dollar index, don't you, I don't know how to ask the question. Like if you go on weekly,
Let me go to
you'll
the
see
dollar.
When you look at the weekly time frame, you can see that there is, if you look to the left, there is a resistance level. It's at a resistance level. Does that mean anything to the indexes, or it doesn't?
Does that mean?
When we look at the dollar index,
Yeah.
like now waiting, when you go on a weekly time frame, it's at it looks like it's at a resistance level. Does that affect the dollar at all? Dollar index?
Does it affect?
Or it's not applicable? Right?
So sorry, the line on my side is so terrible. But if I think I caught the gist of your question. It seems to be at resistance. Would that affect the dollar in any way? Yes, for sure. If that was the question, yeah, for sure. If I look to the left, let's see. Where is the tool that I use?
Let's see.
Is that the level that you're looking at?
That's why that's why sometimes I tend to think that I see things that I can't see on yours.
I know. Guys, we can be looking at the chart, but we want, our interpretation will always vary, and I've always said that, right? We could be sitting looking at the same thing, but we're not going to see the same opportunities. I guess that's the beauty of, I don't know, trading financial markets.
Oh yeah. I think if you go up to 2020, it seems to be at that level. I don't know. On mine. If you go to 2020,
2020, the year 2020.
yeah,
Okay.
it's at that same level now. I
Boom.
don't know.
There we go.
Am I seeing properly? Am I missing something?
The line, the
Am I
line, the
right?
line. Is it just me? I think it's just me. Is everybody else hearing me? Do you know it clearly? What's going on with this connection today?
Yeah, but
Okay. Yeah, there's something wrong.
But do you see what I'm saying?
Yeah, no, you're quite spot on. You see, I had already, it's just in the medium term, had spotted that level of resistance. And I've always said, the further left you go, the more and you see the same thing or similar thing happening at a particular price point, it gives it more significance. It gives it more relevance. So you're quite right. That is very easy to noisy here, but that is definitely a level of resistance. Definitely a level
So
of
my question
resistance.
was, because I'm looking at it, I'm trying to
So well done.
Yeah.
Yeah, sorry, go ahead. The line is, there's a delay in the audio.
I'm sorry. Yeah, I'm just saying I wanted to understand how to interpret what I see on the dollar index. If it's at that measure resistance, must I wait and watch it and see what happens?
Let me put it this way. If you are a bear, where would you want to sell? Wouldn't you say that is fair value for you? You've been waiting for an opportunity to sell. Is it not time for you to be selling?
Yes, I would say that is time, but I think part of my confusion level is when it's at a resistance level, should I not wait to see if it breaks the level, or in fact it fails to and therefore it goes back? I don't know. That's always what I'm always grappling with.
That's
When it's
analysis paralysis.
Okay.
Right? We've always said, this thing is just disappointing me today. Okay. If price is moving up, who's here?
The bears.
Right? Bears are here. Now, if you're a bull, let's say you entered there. Bulls were here. You entered there. When you get here, there's going to be a battle of bulls and bears. Bulls want to continue the move to the upside, but bears are there. That's fair value for them, right? And that's why we say, if you are a bull and you enter at this point, you're an aggressive bull. The risk exposure is greater. Okay. That's where you want to see a violation and a retest. That's where you know that definitely bulls are in control. Bears have failed to take that position, right? And so as a bull, you will then enter only once the violation has happened. The retest, then you go in, right? So in other words, if you are a bear, this is where you should be entering. Now, how will you know that as a bear, that trade has failed? Well, of course, at least halfway. Price moves beyond breaking that point of entry for you. Halfway, half mark. At least that's where your stop loss should be. Right? So, in other words, what I'm saying is, We are at that point. We've gone left to the chart. We've seen how price has behaved in regards to that level. So bears are definitely there. Somebody has been waiting for this to happen for a couple of weeks. Right? Somebody has been waiting for that to happen for a couple of weeks. It has happened. So they're entering those cells. But they've got a criteria. Maybe they're saying, okay, 50 pips beyond my entry, I'm out of the trade. That's what I can handle. Somebody else might say, well, I can handle 100 pips. 100 pips above my entry, I should be out. If it goes beyond that, then I should be out of that trade, take the loss, and review my analysis. So I'm saying at this point in time, yes, you do have that choice. Either you're going to enter at current market price because, well, you've got that opportunity. This is where bears are. But some need a little bit more, right? Some might say, can I see some sort of entry signal to know that indeed it has failed, like you say? That's perfectly fine. But of course, time versus opportunity, you're going to be missing out on some profit potential there.
Okay, I hear you.
It's almost like, this is where the bus stop is, and this bus that's coming this way is going to your destination. Well, that's where you need to catch it. But then as you see coming down the road, you're not standing up. Everybody else is standing up. Right? You can see it's lit up. It's saying Santon. That's where you want to go. But you're still sitting and saying, no, I'm not too sure. I would rather wait. I would rather wait for to ask the driver, is it really going to Santon? Right? And so by the time you actually ask the driver, is it really going to Santon? Everybody is sat down. And so you don't have a seat. Right? So you're going to be standing up all the way to Santon in that bus. I don't know if that's a good example, but
Yeah.
yeah, right?
So what you're saying, Lebu, is that when we look at these graphs, we need to check the history of what's been happening before at that level.
100%.
It's always a good indicator of what might happen.
100%. You know that cliche saying, for you to know where you're going, you need to know where you come from.
Yeah.
Same. So how do you know where you come from? You have to go back into history. You need to understand the history, because history repeats itself. It's one big song on replay, right? And like I always say, that example of, if you've seen one movie by Jean-Claude Van Damme, come on, I think we all know how it's going to end, right? We know, right? If you've seen a movie by, is it Steven Seagal, that guy who doesn't speak much in his movies, we all know how it's going to end, right? So, of course, if you haven't seen a movie by these two movie stars, then you have no idea how it's going to end. But if you've seen one or two, then you start to see the pattern that, okay, so he's always the good guy. He's always the one who kicks ass. He's the hero. You get the point. So the chart allows you to preempt the next possible move just by going left into the chart. And that is the biggest advantage about trading in this day and age, because we've got MetaTrader, we've got TradingView. It's a visual presentation of the markets. It wasn't always this way back, say, 30 years ago. Just the other day, it wasn't like this. And trading wasn't as popular as it is today, because it was arguably much more difficult. But with advancement of technology, we've got would say toddlers even trading. We've got 14-year-olds, 13-year-olds, 15-year-olds trading as well, right? We've got these kids who are participating in what we've always considered a very complex and difficult industry, financial markets, and they're killing it because of the advancement of technology. So we were able to quickly, with a few minutes, go back into time and say, oh, this is what happened. This is likely to repeat itself. Yes, likely. We're not saying it's going to, because we don't have that crystal ball. But based on historical data, likely it is definitely resistance, right? So who's there? Sellers are there. And we can then pair it up also with our fundamentals and say, well, the Fed is dovish. So we expect a devaluation, on the dollar to continue. So are you seeing the reasons for you to enter into the sell?
Yeah.
We've just
Definitely.
seen also with the CME FED Watch 2, 80% plus are saying there's still a cut yet to come. 25 basis points, right? A cut, nevertheless, is coming. That is dovish. That is definitely dovish. So definitely a sell is in order on the dollar index. In other words, risk on sentiment is likely to build up. Right?
Yeah.
Now let's do this. Fine. It's a key level of resistance. From this point here to down here, the predominant color is definitely red. So that's an impulsive move to the downside. So let's see how this price point. Now, I'm not the best, of course, in plotting my Fibonacci, but right, 0.5, it's exactly where it is. I think that gives me much more confidence in that sell probability because we are testing a key retracement level, 0.5.
It's like magic.
It's like
magic.
Yeah, this is magic coming together. So yeah, we've got these tools at our disposal, right? So it helps us. But you see what I like about this? The level was identified by paying close attention to detail. She was able to identify that level. All I simply did is complement or confirm that level by using Fibonacci, and it's just bang on.
Yeah.
Matches or aligns perfectly with that possible turning point. Right. So definitely bears are there. Bears are definitely there. Right? Bears are definitely there. And if we continue to the upside, it's not a problem. 0.6 is another level, right? We might just have what we call a liquidity grab. That's when it goes a little deeper. Okay. This is when it goes just a little deeper. Maybe I shouldn't use this tool. Let me use this one here. Because then we can go back as much as we can, time allowing. See, so now we can shade this entire area. Remember, some have asked, what is a liquidity zone? What is a order block? So we shade an entire area. We know this region of price here. As long as we are below it, is that too? We can maintain that bearish bias. Only once we violate it and close above, do we review that bias and say, maybe that has changed.
Yeah. All right.
Nice and clear, right? So for some of us who have planned on Tuesday already to be risk on with charts like Nasdaq, which have played out quite well, this gives you confidence for anybody who's still holding that position to continue holding it. All you do is just adjust your stop loss to protect the profit that you are in. You get stopped out, it's not the end of it. You've made profit, right? If it continues in your favor, oh, fantastic. You never left the trade. You want to ride this trade for as long as you can, right? For as long as you can. And that's kind of how I trade, right? Yeah, I've got TP1, TP2, TP3 if I'm buying, levels of interest that I've marked out where it could likely turn. But I want to hold on to the trade for as long as I can hold on to it. So all I do is just adjust my stop losses. As it continues in my favor, I just make an adjustment to my stop loss and let the trade run. Simple. I get stopped out, no problem. So that's our dollar index.
Okay.
All good? All right.
All good. Thank
Oh,
you.
good.
So yeah,
Helps
like
a
I
lot.
said, we I can show you how to bake the cake or the pudding, but it's not always going to. Yeah, it's not. How we interpret data will always be a little different. But don't be paralyzed by, am I wrong? I'll be right. Am I wrong? Am I wrong? Nah. You need to analyze, make a decision, and comfortable with the possibility of being wrong. Right? Don't be afraid of losses at all, guys. Right? The main thing is risk management. That's what's going to give you longevity in this. Right? Blowing accounts, very childish. Because that means then we're not applying risk management. Right? Remember, we did a thorough exercise on risk management. You need to have a budget for capital loss. If you're not risking any capital on the day and you're in profit, you need to have a budget for that tithing. And remember the tithing example. You need to have a percentage that you're willing to lose or willing to give back to the market, right? Those are things that really keep you in the game. Okay, I think we can move on. All
I
good?
think for me,
Hi.
I beg your pardon?
Sorry. I have a quick question.
Oh, yes. Please go ahead.
What you just spoke about,
Uh-huh.
this is in previous videos that I can catch up on, yeah?
Oh, yes. Yes, indeed.
Okay, perfect. That's my
All you
only
need
question.
is popcorn and Savannah.
I don't drink Savannah, but okay.
I
Okay,
think for
cool.
me,
You'll end up drinking alcohol. It's the market.
yeah,
One way or the other. I'm
I
joking.
think
Okay.
It will not scare you.
I yeah, I
Yeah,
think for
okay.
me,
Your oros. Yeah, Medino.
I'm saying I think for me, a major takeaway from what you've said is that I've always seen these levels, especially resistance and support,
Mhm.
as levels that you need to wait and see what happens. I've
Mhm.
never understood. I think what you're saying, what I'm appreciating is look at what has happened to the price every time it hit
Yes.
that level. Use that history to inform what might happen going forward.
Oh,
I
yeah.
think for me that's a major takeaway. Yeah.
Oh, thank you. Thank you. No, that's extremely important indeed, right? Especially if it's been happening for years. We can see a major reaction to that particular price point for years and years. Because when I do have the time, I do go back even into the 90s and I just see the same thing, same thing. And I'm like, oh, okay, this level is not to be taken lightly. I shouldn't definitely be buying at this point or selling at this point, right? So it definitely does give you a lot of information. Traders, um, I want us to talk um, monetary policy, right? Time is moving. Time is moving, and yeah, I would say we're falling behind on that, right? We're falling behind on that. We in the last report was let me see, my mind is failing me. I think it was May. I think we read up until May 2019, and we could pick up on a few concerns. What were the concerns highlighted by the Central Bank of the US, the Fed? Does anybody remember? Let's see. Where was inflation? Okay. Where was inflation? Above 2% or below 2%?
Above. I wasn't there, but I'm just gonna say above.
Well, I like you know the like you say, you're not there, but at least you're answering me compared to those who were there.
Above.
Guys.
No, it's because I was on Bloomberg listening to the Americans go on about inflation and like completely confused, but catching here and there from the few sessions we've had.
Yes.
So that's why I said above, because they're very much somber about everything, the decisions that have been made
Yeah.
From September, and they weren't very enthusiastic about their decision today that it would make much difference, which we've seen play out. But I stand to be corrected. I'm learning
Yeah,
and
no, you're quite
growing.
spot on in terms of, your answer. The current, inflation rate is, yes, definitely above 2%. But what we started doing is we went back into 2019, went back, before the pandemic here, so that we can understand the current monetary policy in its context. So we have to go back into time and see what was the economic setup, what monetary policy was implemented, until today. So we've been going a little back, and unfortunately, it wasn't above, it was below.
Okay.
Yeah. That inflation was below 2%, right?
Oh, yes, this was 2019. Okay.
2019, yes. Hence I said you're right in terms of the current inflation. But back then, it was definitely below the 2%. Now we understand that the target
Makes
is
sense.
2, right? They're targeting the 2%. And like I said, it's not always going to stay at 2. But when it goes below the 2 and it deviates by a bit, then it's concerning, because we did say inflation, we can use inflation to measure the state of the economy, the economic wheel, the speed, right? So back then it was below.
Okay.
We also spoke about, or rather the Fed also was mentioning business fixed investments and household spending. Now, I want household spending, that's easy, right? That's us. Business fixed investments. What's that? What is business fixed investments? Anybody?
Building immovable object machinery, right?
But you say that one more time.
Fixed cost of the business. I mean, like building, the land, like that, right?
100%, right? Business fixed investments. We're talking, businesses investing in expansion, machinery, right? That they would use for products, expanding on branches, real estate, land, like you say, technology, right? Investing into technology. That's business fixed investments, right? So was that going up or going down at that particular time in 2019? Was it going up? Was it going down? business fixed investments. And I've let this go for what, almost a week actually. This week we haven't really got into it. So I had given you enough time to go through these, right? But yeah, business fixed investment was a concern. Initially at the start of the year, business fixed investments and household spending was to the downside. Seasonally, we did see an improvement on household spending. June, July, August, remember, household spending, we did see it. We did see growth, but slower compared to the other years. Are we on the same page?
Can I ask?
Yeah.
I see the page you are on. I'm on the same page, but I'm trying to get to the page you're on.
Okay, you're on the same website. You're trying to get
Website, yes.
where I am. Okay, so what you do is you go to monetary policy, and then you go to calendars, meeting calendars and information.
Okay.
Right? And when you go down, you're going to see 2024, which is this year. You scroll all the way down to 2019. It's 2019. Here you go, 2019. And
okay.
You okay now?
Yes, 2019 FMOC meetings.
Yes. FO
Okay.
meetings, Federal Open Market Committee.
Federal Open Market. Okay.
Right. So these are the guys and girls who make decisions on monetary policy. So I'll explain it for you quickly, right? Even though you're going to find it definitely on the recording, but so that you catch up just for today. The US actually has 12 central banks, right?
Okay.
So out of these 12 central banks, each central bank has got a president, or I don't know if they would say a president or a chair of that district. So each and every head of that district forms part of the FOMC. So they'll come together. So everybody knows the federal chair, which is Jerome Powell. He's the big boy.
Yes.
But then
yes.
He doesn't make decisions. He can persuade the decisions to be made in a particular way, but decisions, something happens. Everybody's got access to the session, same data, and they would vote on right. So Jerome Powell is just, well, I wouldn't want to say that just the face, but yeah, he does play a significant role in persuading monetary policy to move in a particular direction, right? Yeah.
Okay.
So these are scheduled meetings. They have about 12 in a year. Am I right? 12. Yeah, I think. No, I lie. Let's go back. The 12. Jan, yeah, all the months are here. Jan. Okay, we don't have Feb. But I do know we have 4. So we've got 4 quarters. Yeah, there's 4.
Yeah.
There's 4 projections meetings there. Out of these other meetings that they have, 4 are very important as well. Not to say the others are not important, but there's 4 that are very important, which basically this is where they do their projections, right? The ones that have projections, you'll see them with the star next to the date. Those are the ones that include.
Okay.
Yeah, right. Those are the ones that include. And then also, under special, I guess, circumstances, we have unscheduled meetings, right? And we saw a whole lot of those back in 2020, right? They wouldn't just wait for the normal scheduled time. It wouldn't have worked. So they would meet whenever they needed to meet to make adjustments to monetary policy, right? You can't see, you can't just sit back and say, okay, well, we can see things are going south, but we can only meet in a month's time, right? They have to definitely have an unscheduled meeting to make a decision on monetary policy to remedy the situation. So back in 2019, this is before the pandemic, right? And we wanted to understand the economic climate that the US and possibly even the world that was in, right? So we could see, or so far for 2019, where's 2019? Which year am I in now? 2020, okay, this is 2019. So far for the year 2019, we can see, or we're picking up that the economy was slowing down. The economy was slowing down, right? There is mentions of household and business fixed investments slowing down. What else did they talk about? I think I did write down some of these. Oh yeah, so I said mainly let's also keep track of the inflation, rather of the interest rate. Inflation is below 2%, below their target, right? But the interest rate at that particular time was at 2.5, 2.5, right? So let's just quickly check. This is May. Let's look at May quickly, and then we'll go into June. Okay, so these reports, they will always, at first glance, look the same, but they will tweak one or two words, and it's important to pick up on that, right? You want to read it and read it again and compare it with the last report, because the Fed tends to say a lot without saying much, if that makes sense. Right? So they don't want to put themselves in a corner. They won't spell it out, right? They're like, I guess, women to a certain degree.
Wow. Okay.
I knew it. You know, see her acting funny, but you have to figure out there's something wrong that you did. Yeah, I guess
I get you, true.
no. So that's the Fed, right?
Okay.
Yeah, they say a lot without saying much. So the biggest difference, of course, that you're going to spot is a monetary policy change. Now, that one you can't miss. Interest rate being changed, well, that's easy to see. And that's a big impact on the market, right? But leading up to a change in monetary policy, or leading up to a monetary policy shift of some sort, we're definitely going to see a change in the wording, in the tune, or in the tone rather, right? So this report reads like this: information received since the FOMC met in March indicates that the labor market remains strong and that the economic activity rose at a solid rate. Job gains have been solid on average in recent months, and the unemployment rate has remained low, right? Growth of household spending and business fixed investments slowed in the first quarter. So this is March. The first quarter is January, February, March. This is May, sorry, right? So we've gotten the data for the first quarter, and we're seeing a slow down in basically economic activity. On a 12-month basis, overall inflation and inflation for items other than food and energy, which is basically core CPI, have declined and are running below the 2%. Like I said, inflation can be used to measure economic pace. So we're definitely seeing inflation going below the 2%. That is a concern. If it wasn't, they wouldn't mention it, right? On balance, market-based measures of inflation compensation have remained low in recent months, and survey-based measures of longer-term inflation expectations are little changed. Inflation expectations, remember I said I will talk about it, right? But I think let me just get it out of the way. So inflation expectations are very important, right? It's a survey that is done by various universities and research organizations. Now, what it is, it's done, or this survey is conducted on households and business, right? On households and businesses. So what they're trying to determine, or what the survey basically seeks to find out is the perception, right? Our attitude towards inflation, right? So they'll go to businesses and say, based on the current economic setup, the situation, and based on what the central bank is doing, where do you believe inflation is going to be for the next month, for the next quarter, maybe for the entire year, right? And so they take in that information and they want to see if that expectation is in alignment with the Fed's policy. So remember, the Fed is always targeting 2%. Now, if inflation expectation numbers come out higher than 2%, there's a divergence there. There's a problem, right? Especially the one coming from business. If business say we see inflation at 4%, that's a problem, because then what it means the Fed has got an even tougher job at getting those expectations back in line, right? Or meeting their 2% target. Because what's going to happen is that businesses that genuinely believe that inflation is going to remain higher for longer, inflation is going to stay higher for longer, they will price it in, right? So that means the price for goods and services will stay high. Are you following? If I'm a business owner,
Yes.
this is basically what has been happening in China for the longest time with their inflation, right? Inflation, well, they didn't suffer from inflation. They were suffering from disinflation for years, right? Where prices were not rising at all.
Oh, okay.
Right? Everywhere else in the world, prices are rising on a 2% rate. But with what you call this, with Japan, not China, with Japan, it's been the opposite. They've had a disinflationary economy. In other words, that economy wasn't growing. It wasn't going anywhere. And when they were looking at inflation expectations, they were low. They were below 2%. In other words, those businesses were not willing to hike prices, right? Nobody was willing to price themselves out of business, basically, if I can put it that way, right? Everybody's looking at each other like, hey, okay, well, if my neighbor next door is not hiking prices, then I'm not going to hike prices as well, because I mean, if I hike prices, of course, he's going to get the business. Everybody's fighting for the little business that's there. And so who gets to benefit in this instance? Of course, the consumer. Everything is lang cheap in Japan. But who wants to really invest in such an economy that is really not growing? No one, right? And so the savings rate was extremely high in Japan. So what does Japan do? They lower the interest rates to a negative to discourage saving so that spending can go up. The demand for goods and services, they wanted that to go up. And of course, if demand for goods and services goes up, then prices will likely rise as well. So it took them a while to get eventually that inflation, in other words, prices, to move up. You follow?
Yes, still following.
Okay. So with the US in particular, at this particular time, they were looking at their inflation expectations and they were low. Nobody was seeing the possibility of inflation moving higher. And so that's a concern. So they're always trying to find a balance as the Fed, right? We need to get inflation expectations near our target of 2%. That's what they're always trying to achieve. Because if it diverges by too much, then they've got a problem. If it's 4% and they're trying to get it to 2%, then inflation remains stickier. It remains higher for longer. So what do they have to do? Think about it. If inflation expectation surveys come out at 4%, and we understand that the target is 2%, what would the Fed have to do in terms of monetary policy action? What would they have to do to get those inflation expectations down to 2%, or rather back in balance? Shaking, eh? It's not. You've got the answer, but you're just afraid to give it to me. You don't want to sound wrong. It's simple.
Yeah.
It's simple. It's simple. They will look at their interest rate and say, okay, we have to hike. Let's hike until they believe that inflation is going to come down. Because
Okay.
when you hike interest rates, first they'll start by, of course, they'll always give us forward guidance. This is where, we believe inflation is moving in the right direction. They'll try and persuade us by talking about it first. And if that's not working, well, in fact, they will even mention in their forward guidance. They'll say, we are moving in the right direction, but a little slower. We've lost momentum to get down to 2%. Inflation expectations are still high. If they remain high, they tell you, if they remain high, we are likely going to stay with high interest rates, or even actually hike them further to bring inflation expectations and inflation down to our 2% target. You follow?
Okay.
Mm-hmm.
Yeah.
Right. So
Sure.
I'll show you guys where you can find that inflation expectation data on trading economics. It's not something that you're going to find on the regular site like Forex Factory, right? So they say, consistent with its statutory mandate, the committee seeks to foster maximum employment and price stability. Most central banks, that's their mandate. Price stability is inflation and maximum employment. Well, that's what it is. In support of these goals, the committee decided to maintain the target range, for the federal funds rate. We're talking about interest rates there, at 2.25%, another is 2.25% to 2.5%, right? 2.25 to 2.5%. Right. So now the number that, like I said last week, guys, the number that we always pay more attention to, or the one that will always pop up on economic indicators is the last one, right? It's this one here. Why is this thing not writing? Okay, this one here, right? The 2.5. In other words, the 2.50. Right? But we know we are ranging between 2.25% and 2.50. But the one that you're always going to see is the last. It's the bigger number, 2.5. Right? So they decided to keep that interest rate unchanged. And remember, yesterday when we were talking about cyclical trends, and I said, if you look at the year 2023, not 2023, 2019 and 2020, we can definitely see that Nasdaq was moving like this, right? And for the year 2021, 19, interest rates, you can see they were not at 0, right? This is May, and we're still sitting at 2.5%. Yet the stock market continued to yield a return, right? Okay, let me not go that direction. The committee continues to view sustained expansion of economic activity, strong labor market conditions, and inflation near the committee's symmetric 2% objective as the most likely outcomes. In light of the global economic and financial developments and muted inflation pressures, the committee will be patient as it determines what future adjustments to the target range for the federal funds rate may be appropriate to support these outcomes. Right? So this is what month? May. Let's move on to June. Okay, let's just do this. Let's go to June. Let's clear the drawings. Let's see what June has for us. Now, June is pretty much the same. Okay. Let's see. Economic activity is rising at a moderate rate, yet again, job gains have been solid on average in recent months, and the unemployment rate has remained low. Although growth of household spending appears to have picked up earlier in the year. Remember, I said seasonality, June, July, August, right? Indicators of business fixed investments have been soft. On a 12-month basis, overall inflation and inflation for items other than food and energy are running below 2%. They're mentioning the same thing, right? Market-based measures of inflation and compensation and inflation compensation have declined. There's a difference now. If you compare that last month's one and this one, slightly different now, have declined. Survey-based measures of longer-term inflation expectations are little changed. So inflation definitely continues to come down. This is June. Consistent with its statutory mandate, the committee seeks, let's move on. They decided to maintain the target range. So interest rates still unchanged. They're still at 2.5%. Right? Let's see. The committee continues to view sustained expansion of economic activity, likely outcomes, but uncertainties about this outlook have increased. That wasn't there in the previous month, right? Uncertainties about this outlook. What is the outlook? The outlook of expansion of the economic activity. It is rather uncertain now. The uncertainties have increased. We're all on the same page. I haven't lost anybody at this point. Last month,
no, we're still here,
right? Last month and the previous months before, they've been talking about expansion of economic, sustained expansion of economic activity. They have, they were, mentioning here and there that things are slowing down. Inflation is below 2%, but they continue to keep the interest rates unchanged, right? It's June, yet another month. They keep the interest rate unchanged. They make mention of that inflation is running below 2%. They still see the possibility of an expansion of an economic expansion, but they do say uncertainties about this outlook has increased. In light of these uncertainties and muted inflation pressures, the committee will closely monitor the implications of incoming information for the economic outlook and will act as appropriate to sustain the expansion with strong labor market and inflation near its symmetric 2%. So this okay, I guess that's what it is, right? There's nothing out of the ordinary here. It's pretty much the same. Let's move on to July for the sake of time. July. That 2% on inflation, they will make mention of it. Let's see. Job gains have been solid on average in recent months. Unemployment has remained low, sharp. Although growth of households and spending has picked up from earlier in the year, growth of business fixed investment has been soft, right? On a 12-month basis, overall inflation and inflation for items other than food and energy are running below 2%. There it is again, right? Let's move on. Consistent with its statutory mandate, the Committee 6, we already know that. In light of the implications of global developments for the economic outlook, as well as muted inflation pressures, the committee has decided to lower the target range. So for the very first time, there we go. We've got those interest rates now being cut. They decided to lower the target range for the federal funds rate to 2% to 2.25%. It's no longer 2.25% to 2.5. It is now 2 to 2.25%. Right? This section supports the committee's view that sustained expansion of economic activity, strong labor market conditions, and inflation near the committee's symmetric 2% objectives are the most likely outcomes. But uncertainties about this outlook remain. Right? So there's something that they make mention of here. In light of implications of global developments for the economic outlook, and as well as muted inflation pressures, the committee decided to lower. So something pushed them. What are these global developments for the economic outlook? Something was taking place then, right? The economy was slowing down, and they were making mention of it, and they were paying close attention, like they said. But something happened that pushed them to actually take action and lower interest rates. So I thought about it, and I said, oh, okay, well, it's easy. If I can't find it, surely I can Google it, because I can't remember up to that point. But then as I did do some searching, I found the IMF Global Economic Outlook, which I find very important and interesting to follow as well. IMF, the International Monetary Fund. You've heard of them? This is a research organization, International Monetary Fund, and they're also, of course, I don't know if I should say they're a bank, but yeah. Have you heard of them before?
No.
The IMF. Okay, so the IMF.
Yeah, we've heard of them.
Okay, some have. In fact, this year's first economic outlook report was actually done here in South Africa. So it was hosted in Johannesburg. I did get the invite, but I didn't get a chance to go. So I missed out on something nice and big. Yeah. So the IMF, they give us an outlook. It bears a lot of weight. It's very important. A lot of economists, do follow on these reports by the IMF. We've got regional reports, we've got global reports as well, right? So when you do have time, you will remember anyway by listening to the recording. Go to the IMF website and go back to 2019, and you'll see that they actually do make mention that the global economy is slowing down by quite a bit, right? The global economy is slowing down. So the Fed decided, okay, we need to do something about it. So they cut the interest rates. Now, that's not the only thing that they did. Let's see what else did they do. In determining the timing and size of future adjustments to the target range for the federal funds rate, the committee will assess realized and expected economic conditions relative to its maximum employment objectives and its 2% or its symmetric 2% inflation objective. This assessment will take into account a wide range of information, including measures of labor market conditions, indicators of inflation pressures and inflation expectations and readings on financial and international developments. Readings on financial and international developments. Reading on financials. Those financials would be the IMF reports, OPEC, economic outlook reports. So these global economic reports, they help quite a bit. You're going to find one by Bloomberg as well, and it goes on. International developments, well, it could be anything. An example could be a war, right? Could be that geopolitical event, a war taking place. God forbid, another 9/11, right? Things like that, right? The committee will conclude the reduction. This is what I find very interesting. So there are two important things. We get a monetary policy adjustment, right? Interest rates being lowered. Is that hawkish or dovish?
Dovish.
That is dovish. What does that do to the dollar?
Lose value.
It loses value. They're increasing the money supply. When you lower interest rates, you increase money supply. When you increase money supply, you devalue the currency. And so therefore, the dollar index, the dollar price on the chart comes down. Remember, the more you have of something, the more it loses value. So that is one thing that they did. They lowered the interest rates. They are very, very dovish. The committee will conclude the reduction of its aggregate securities holdings in the system open market account in August, 2 months earlier than previously indicated. So I guess this one we missed, but if we go back into time, we may find where they started the reduction, right? What is this reduction of securities? It's a monetary policy tool that we did not mention. Remember, we mentioned the following here as monetary policy tools. The Fed can use 4 tools to achieve its monetary policy goals: the discount rate, reserve requirements, open market operations, interest on reserves. Right? These are the ones that we spoke about. But this is not the only tools that they use. There's QE, quantitative easing. There is QE. And if we speak about QE, quantitative easing, then we have to talk about tapering. Right? Tapering. Some may call it balance sheet reduction. Balance sheet reduction. I want to show you something. So I went back into time. I'll conclude with this and then we'll continue in the new week, I guess. So I don't bombard you with a lot of information. Let's look at this here. So this site has got a lot of data also. So here we're looking at the Fed's balance sheet. Righty? The shaded area. Does anybody know what happens in this time period here? I think 2020 might give it away because it's recent.
I think the 2008 should be the financial crisis, then 2020 should be the COVID.
100%, right? So these shaded areas are recessions, right? And we can go back into time and find even more shaded areas. There's a lot of them, right? But notice that the balance sheet spikes during recessionary times, right? And I would say this is the largest spike in history. In fact, in the entire financial history of the US, right? What the spike is, this is money supply, right? This is money injection into the economy. Now, we had that in 2008, right? It spikes and it gradually continues to pick up and 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 pick up. Then eventually it flatlines and it starts to go down. So this is basically where they likely started their balance sheet reduction. In other words, taking out that money out of circulation, right? Taking out that money out of circulation, excess reserves, taking all that money out of circulation. But I guess as they continue to do this, the economy now started to slow down maybe a little too much than what they had initially hoped for. So this is August 2019. The report that we've just read is what month? July. What comes after July? August. So we can see from August, October, August, it starts to pick up again. See that? The money supply starts to pick up because, well, here they already indicated that they will stop that balance sheet reduction. The committee will conclude the reduction of its aggregate security holdings 2 months earlier than previously indicated. So they were meant to continue basically selling off and not holding on to these securities. What are these securities? Bonds, right? We're talking about bonds. Bonds that, where did they get these bonds? Where would the central bank bought these bonds? Where would they have bought them from? Or who would they have bought them from?
From government.
From government. Right? From government. Through treasury. Right? So they would have bought, as you can see, they would have bought them by the billions during the crisis, right? To stabilize the economy. And then they would have sold them over time. Now, they would have taken out that money out of circulation. And so we start to see cracks in the economy. In 2019, we start to see those cracks, but they become much more prominent near, I would say, or in the second half of the year, they become prominent. And so the Fed starts to act on it and say, hey, hang on, okay, maybe we need to stop being hawkish and be accommodative so that we don't push the economy into a recession. Remember, I said they're always trying to find a balance. Always trying to find a balance. So that is what they did for the month of July. They lowered those interest rates down to from 2.5 to 2.25. And they stopped that balance sheet reduction, also known as tapering. So I will ask you that all you do is read the following report, which is September for the weekend, right? Go and check if they did any further reduction. And if so, what could have been the reason for doing so, right? So this is September. Any question? Okay, if there's no question, I've got a question then. Fine. Many people are looking at inflation given for as one of the reasons why the Fed has recently decided to cut interest rates, right? And not only just the inflation moving towards its 2% target, but also there was a big concern. What was the concern? Inflation was, inflation was moving in the right direction, but there was a concern. For them
Wouldn't it be the elections coming up? I'm just guessing now.
Well, you know that the Fed has always said they're not politically affiliated, or their decisions are not politically motivated. Let me put it that way. I think affiliated, yeah. Well, I mean, the appointment of the federal chair is done by the president, so I guess there is some affiliation there, but they are independent in terms of decision making. But like I said, we've seen in in many cases that, the last 2 years leading up to the elections, they tend to be much more accommodative, right? So interest
I
rates.
say that because when I was listening to um what is it? I think it's
I think it
Bloomberg
was
because
because of the labor data. The labor market was slowing down.
Okay,
Is that
hold
it?
on, Bruno. I want Zania to finish her point.
I was saying that I think because when I was listening to the Bloomberg people speak on the time that I had them live, they were busy comparing the two presidential candidates that now I forgot. Trump was more beneficial to I've forgotten, but
Yeah.
he's beneficial to people who like the more financially geared people, where Camilla is more for like I think stocks and bonds. Anyway, never mind. Yeah,
No,
something
but I
like
get
that.
your point, right? There'll always be the comparison. This president is more pro-business, and the other one is more pro the people or whatever. So
Yeah,
there's
but they were
always,
saying that Trump impacts financial markets in a more positive way
yes, positive.
than Camilla would impact stocks and the other side. I need to do my research more. But
No,
I
I fully.
understood what they were saying. I just can't articulate it as well.
Yes. Now I fully get you, right? I fully understand. And that there will always be that comparison. Who has, is likely to, impact the markets more positively. We've seen definitely with Trump, the markets have been absolutely great. He did not initiate any war on anybody. If there's any war that he initiated, in fact, he brought back all the troops from all over the world, right? So I think he had a lot of good to do for the US economy. He didn't spend a lot of money on military. In fact, for the first time, a US president met up with the Russian president. What else? What else? I mean, we can go on. If there's any war that he initiated, is the trade war against China, and it wasn't a physical war. It wasn't bombs being dropped on people's heads. It was a tariff war. It was one of,
Mhm.
international trade, saying, okay, China,
Mm.
you need to play fair. You are dumping X, Y, and Z on us, right? So you need to
It
slow that.
was a Make America Great Again
I beg your
war.
pardon?
It was Make America Great Again war.
Yes, that was the slogan. Make America great again, right? So to a certain degree, Trump was their Jacob Zuma. Because I mean Zuma actually
Okay.
get the economy of Jacob Zuma, our former president, it wasn't that bad.
Yeah.
It was actually quite good,
No, it wasn't.
right?
Yeah.
Quite good.
Yeah.
So he was their Jacob Zuma, right? Much as they want to paint him bad, yeah, he may have had his things, but generally speaking, the economy is actually doing very well. And
Yeah.
yeah, but that's not quite the answer here.
Okay.
Bruno had it. Bruno,
No.
is Mr. Bruno still there? Yeah, Mr. Bruno, go ahead. Go ahead. I think you had the answer. I think Mr. Bruno is at work, so from time to time he may not be able to answer. But let me go ahead then. So the other concerning thing that led to the Fed cutting interest rates the other day was the labor market, right? It was the labor market. So these statistics are put together by the BLS, the Bureau of Labor Statistics, and they've been underreporting on labor conditions or the labor numbers. Let me put it that way. And just the other day, before the Fed actually cut the interest rates, they made an adjustment or a review. Is it what? Not a revision. That's the right word. They revised the unemployment numbers by quite a bit. They showed that they missed it by, I think it was 80. Was it 80,000? 80,000, or was it 800? No, I don't want to. Let's keep it at 80,000, right? Uh, they missed it by 80,000. There was way less jobs created than initially thought. And so this basically changed the tune. So the Fed saw the labor completely different. Something that was coming down, which is good, sure, but then with that revision, it proved that actually, hang on, this is rather a little bad. We shouldn't be too low. And so that's why they cut the interest rates, right? So that's the understanding out there, the labor data, right? The labor data, it's weak, and we've got inflation also fine, moving in the right direction. So let's cut the interest rates. But that's not the only thing I was paying attention to. And I suspect the Fed also, because I think it went a lot over a lot of people's heads, because I was quite pleased with myself because I've been looking at this data for some time. And then just before the decision was made to cut interest rates, some days before, or let's say weeks before, when Jerome Powell was, giving us his speech, he makes mention of these two particular indicators, that I was looking at. So I want to share them with you so that you can see also what contributed to the Fed cutting interest rates. And the other one is personal savings rate. It's personal savings rate, and the other one is credit card delinquency rates. Right? Those are the two that I've been looking at very closely. So let's go to the homepage here. And I want us to look at the savings rate. So for us to put this into context, we have to remember that in 2020, interest rates get cut to near zero. Okay? Let's look at the interest rates just one more time. In 2020, those interest rates get cut to near zero, right? All the way down, we stay there for a solid 2 years, right? Now, the first year, of course, 2020, a good part of it, nobody was going to work. Nobody was allowed to. We were not, in South Africa, I think they took it a little too far. You couldn't even buy a packet of Simba chips, right? They were cutting off, like it really would affect your health. So we've got, people at home, and some were still being paid for being at home, right? And so you can imagine interest rates are super low. In other words, the access to loans or credit is rising, and the money supply increases, basically. Let's put it that way. The money supply increases, and people are taking up, because remember I said, we live in a world of credit. That's what makes the world go, the economic wheel turn. So if interest rates are low, we take on that money. It's cheap money. We want it, right? But now we have that cheap money available. And in the US, so let's talk about the US setup. In the US, people were paid $1,800 every other week to stay at home. $1,800. In South Africa, well, geez.
What?
Yeah.
$1,800. 1,800 rand.
Yeah.
I mean dollars.
Dollars, yes.
To stay at home.
And we were paid not even $30.
Wow.
And apparently,
I love that. Wow.
And apparently, I just learned this from a colleague in the industry the other day. He said, "Hey, do you know of this guy, blah, blah, who is actually kind of in hiding, because he made mention of the fact that actually we got a lot of money, I think, from England, the South African government, and we were actually supposed to be getting 4,000 rands every month, right, to stay at home. We're supposed to get 4,000 rands, which is basically about 240 let's say $240, give or take, right? To stay at home. But these guys made the money here. They said, let's just give them, they're going to be, let's just give them 300.
350.
So this guy's in hiding because.
So is this beyond the, how much did they give us? 500 billion or 5 billion?
Yeah, this is beyond.
So beyond that.
Yeah, that's another fund, right? That was just, to keep the economy stable and we do whatever we needed to do. No, there was other money from the Queen herself to say, no, my people, being a former colony, here's something for you,
Wow.
And a topic for another day. A topic for another day, right? So we've got the Americans getting $1,800 every other week. We've got access to these cheap loans, access to, cheap credit. So, but you can't go out there. So most of that money you can't spend. Right? And remember the thought, I don't want you to get lost here. When you have high interest rate, it discourages borrowing of money, right? High interest rate, that discourages you from getting credit, right? Borrowing money. And it encourages you to save money, right? Yes. Because, well, leave your money there and you get some returns on it. It encourages you to save money. So I want you to remember that. That's how it works. So here we've got low interest rates. So there is no incentive actually to save money. But this was a rather unique situation because you couldn't spend the money that you had access to. So this is something that I was thinking about and going back and forth. So I found the savings rate, the personal savings rate. That's important. A different thing is personal savings rate. United, let me just stuff on the screen here. Let me put it here and try again. United States personal savings rate. So you see inflation is going down. Sorry, not inflation. The interest rate is super low. So under normal circumstances, if your interest rates are moving like this, your savings rate should also move this way. Right? If your interest rates are moving this way, your savings rate should move this way. If your interest rates are moving this way, your savings rates should also increase. In other words, your interest rates and your personal savings rate usually move in the same direction. You follow?
Yeah.
But this time around, it was a little different. Look at how the savings rate actually spikes while we have the lowest interest rate seen in the longest time. 0.25. But your savings rate spiked. Whoop. And I actually bumped into this by chance. Well, it's just because I just sometimes give myself difficult tasks, and after having lunch or on a Sunday, I start my work, I do a review, right? So I bump into this. I'm like, no, hang on. This challenges my understanding of interest rates versus savings. So then I quickly understood, oh, yes, nobody could spend the money. It makes sense. That's why
we were locked in. We were locked in.
We were locked in. So the savings rate spikes, right? But now, fine, it spikes. The rollout of the vaccine kind of, comes into play, and, people start really spending that money, and it spikes up, and eventually, of course, that money is being spent, right? We've got low interest rates. There's no incentive to save that money. So things kind of go back to normalcy. But now, 2022, interest rates start going up. Let's go back to the interest rates. And they are hiked quite aggressively. So if interest rates go up, the savings rate should also go up, right? So let's do this, say 5 years again. 2022, they start to hike. And I said interest rates and savings rates should move in the same direction. But that's not what we see. It flatlines for a little while, right? 2022, it flatlines, it picks up just a bit, and it really drops. So if you look at, in fact, for this year alone, you really start to see that, hey, look for the month of, really, people don't have that money there. The personal savings rate is starting to really drop. I think if you look at it this way, then you really start to see that actually it's not going anywhere. It's supposed to be picking up and moving in alignment with the interest rates, but it's actually quite flat. So I asked myself again, but why? So I couldn't get the answer right away. So what did I do? Popcorn and?
Savannah.
Thank you. And then the answer came. And I thought, oh, honestly, people don't have money. It's a luxury to save. It's really tough, honestly. It's not just unique to South Africa, but really everybody that I'm speaking to all over the world, it's really tough. So saving is a luxury. I mean, you can't afford to save. What are you saving if you're living hand to mouth? So regardless of high interest rates, the savings is not going up. So I thought to myself, hang on. I remember 2008 and 9 very vividly because I wasn't as smart as I am now. And that's how I lost my homes and cars. So what was I doing back then? And I thought, oh, shucks, I couldn't save money. I was living hand to mouth. And geez, I went for credit wherever I could get it. Nedbank, Standard Bank, FNB, I had all those credit cards. And when I maxed those out, I went for African Bank. They were the most reckless people to give me money. I mean, they gave me, I think I wanted like 15,000 and they gave me like 80. I was like, what? I'll take it all. So that's how bad I was with money then. So was I paying off those credit cards? No. So I said, okay. So it got me to this, which is the credit card delinquency, people who are not paying. Credit card delinquency. Where is it? Let me just move these things out the way. And credit card. How did I find a credit? Okay, let's say US. Okay, I see US credit card. I think I'll find it here. Personal, it should be under personal, commercial, asset measures, delinquencies on all loans, and well, that too would look rather bad, but I'm looking for the credit card, the one that I found. United States. Okay, let's go for more. Credit card delinquencies. Where are you? Where are you? Where are you? United States credit card loans not among United States domestic reporting credit cards. I found it so easy the other time. Let me do this. Where's the search bar? Credit card delinquency rate. Delinquency. How do we spell delinquency again? United States credit card accounts. Let me put US. Let's put tightening. Nope. United States delinquency rate. United States delinquency rate on credit cards, loans, banks not among the 100 largest. This could be the one. United States Commercial Bank interest rate credit card. I think this is the one. delinquency rate on all credit card loans. Look at this. See how the delinquency rate has gone up.
Yeah.
Right? Look at that. So people are not paying. So people are in such a corner that they've depleted their savings. Regardless of how high interest rates are, they were basically left with no choice, or they are left with no choice but to still go and get that credit card, because the money that they're earning is likely not enough to cover all their monthly liabilities. And so they go for those credit cards and they honestly can't afford that credit. The interest rates are extremely high. And so the delinquency rate spikes. So there's a credit crisis boiling beneath the surface.
So would you say, and I'm being very dramatic, that history is repeating itself in terms of that from 2008?
Yes.
Because, oh, okay.
100%.
Because like obviously like a few like people in the work that we do have been like saying like, but I feel like they panicked too early, where we might really see it going forward. Yeah.
No, yes.
So
Yeah.
how did we trade in 2008, and how do we take advantage of that if history is to repeat itself?
Ah, what a lovely question. Right? Because I made a promise to myself after 2009. I said I'm gonna learn as much as I can about how really financial markets work, because I was fairly new into the trading thing and investing, but I was doing it because it was something that you needed to do. I was still in the workforce, and so I learned a lot. And this past one, 2020, we made a decent returns in terms of the investment portfolio and my trading accounts. And I remember it got even easier for, I would say, South Africans especially, but now this is also made, I think, available to other countries. There's an app that was developed by some guy, I think is and you'll see a lot of Facebook pages about it, where now you can actually, on your own make those investment decisions. I forget what it's called, man. It is such a fantastic app, because under such conditions that are about to unfold, which is a recession. Guys, I said there is, smart money or wealthy people don't opt for cash, right? Because once they disinvest, that money needs to go into a bank account, and that means then they become liable for tax. And so the wealthy always get wealthier during recessions as well, and they actually get or pay a lot of money in terms of tax because they don't declare that much. So their money is always within some sort of investment vehicles. So they will always rotate from one asset class to another. That's how smart they are, because there are stocks or assets that will perform well during a recession.
Yeah.
So what could those be? Let's think about it logically. And these are the ones that I invested in also in 2020, because I've been waiting for this recession. Remember, the last one was 2008. And I've been waiting for it since 2018, because I saw that there was a pattern. Every 10 years or so, we have a global economic reset. So already from 2018, for things to collapse so that I can, make some decent bucks. So the ones that do well are known as staple stocks. So what are those staple stocks? We can talk about food. At the end of the day, you need to eat, right? At the end of the day, those will remain stable. People need to eat, so they will do okay. The ones that do exceptionally well are the ones like pharmaceutical stocks. So I bought the Aspens, I bought the Adcock Ingrams, I bought GlaxoSmithKline, GSK, I bought them all, right? Because, well, when people are losing jobs and the economy is bad, people get sick. You're stressed,
Yeah.
you get sick. You go to a doctor, you get medication, right? It sounds funny,
Yeah.
but it's literally true, right? And so those do exceptionally well. Your pharmaceutical stocks do very well. Your alcohol ones also actually do well. People, when they're stressed, they drink.
True.
You've got your last $50. Oh well, screw it. Let me drink and sleep.
Savannah.
Let me drink my Savannah and sleep. I'll have a plan tomorrow. Right? So those are just some of the stocks that will definitely do well under such conditions. And we can have this conversation, I guess. We can revisit it and delve a little deeper on it. Right. It's just the sake of time, unfortunately.
Yeah.
We would have to conclude, right? So this is the two indicators, guys, that I was looking at very closely, and I'm still paying close attention. So this is spelling a disaster. It's definitely showing me there's cracks in the economy, right? Things are not okay, right? Things are not okay. And there's another indicator, by the way. And that one, oh man, I'll do it on Monday. It's already 9. We are 30 minutes over our time, right? So that one is got to do with two. We compare two bond yields, right? So when it comes to bonds, you've got your 2-year, your 3-year, your 5-year, your 10-year, 20, 30 years, right? You choose which type of bonds you want to invest in, right? So the 2-year means it matures in 2 years, etc. 5 years, it matures in 5 years time. So we compare the 2-year one and the 10-year to determine the health of the economy. And that too has been ringing alarm bells or warning bells for some time, actually. And so let's look into that one on Tuesday, right? On Tuesday. Guys, it's been fantastic. Fantastic
I
session.
have a question.
Yeah, please
Sorry.
feel free. No, ask as many questions as you like.
I'm gonna ask with someone, which I'm not at that point right now, but if you are now making plans to
Uh-huh.
ride out the recession that's coming,
Mhm.
and you've not invested in the top 3 you've mentioned, is it already too late?
If you haven't invested in the ones that I've just mentioned, those sectors,
Yeah,
no, you're not
yeah.
late at all. No, not at all. Not at
Okay,
all. You are not late at all, right? You
okay,
definitely want to get on that. Definitely.
okay, cool.
Yeah. I'm trying to remember, man, the app that would give you access to all these. Like it's such a great app, man. Um
Well, you type it on the group when you
yeah,
remember.
when I do remember, I'll share that with you because it's got all these stocks, right? And it makes it so much easier. I mean, you can, yeah, I think it takes away this whole traditional way of investing, having to pay a monthly fee for to a broker, be it, Sesfin or Invest,
Mm,
Stanlib, or Old Mutual. You can actually do it yourself. But I wouldn't say if you have those investment portfolios with these investment firms, you should close them down. No, let those run. Let them, this is you now having a bit of fun with your taking a bit of control of your investments, right? Formulating your own investment strategies. With the other ones, you're just chucking money at those guys, and they'll do it for you, right? So yeah, I will remember and I will share it with you. Thank you very much, guys. It's been
Thank
great.
you.
thank you.
You send me my love letters. Share this. Shia.
Yeah.
Have a great weekend. I'll see you in the new week.